Hello and good morning, listeners. It's the day with a new high trading for USDINR. Rather, in case with many of the currencies, we are seeing a lot of highs being made against uh, for USD rather against other currencies. I mean, USD has strengthened to all-time good high levels against Japanese yen, Chinese yuan, while previous weeks we have seen Euro, GBP, Aussie dollar, everything weakening against the dollar. So basically, an unprecedented strength in USD against the rest of the currencies. Does this say the US economy is performing or doing extremely well in these phases of concerning global economic macros? Not so much, but kind of a good demand that we're seeing for the dollar against all the currencies. Though the other markets were mixed and not so active, we did hear an announcement by the BOJ on the emergency bond buying operations as the yields climb, while the Hang Seng was seen at the lowest level since May 2009. Now, that's quite an interesting set of events happening across the financial markets. JK, what's your take? What's going on?
Good morning, Shikhar. Uh, yeah, it was the turn of rupee to take the limelight yesterday, and the currency hit another a new all-time high. Rather, the USD INR hit a new all-time high without actually any new fundamental trigger or a news, and it was purely a matter of outflows, which was not met by RBI, who suddenly moved out. They were seen selling at 80 to 40, and yesterday they just vanished. And it was enough to trigger a lot of stop losses, as well as the buyers actually hitting whatever offers they were getting. And the move of almost one more than 1% in the last two sessions was really something unprecedented without any fresh news. That is the take away. And obviously the dollar index moving freshly higher, particularly in the yuan and yen, has also influenced the rupee. But I wouldn't say a 1 rupee move from the low of the Tuesday's trading till yesterday's uh, uh, close was not justified, looking at the amount of outflows that we heard. But that's the way Indian rupee behaves. And one is, I mean, market is now really convinced that central banks' actions are not even towards containing volatility. It is just only to slow the fall of the rupee, and they remain unpredictable as ever. Where they come in, how long they remain, and so it is imperative that one should be focusing on their own risk management, and dips should be used by importers to buy, and exporters can probably keep stop and run their position unhedged. So that's the only strategy that I can suggest. Of course, we did have the company of yuan and yen in these multi-decade lows, defying verbal intervention from authorities of both the countries. Even PM of Japan was speaking against the one-way move in the currency, but market has brushed aside these comments and moved steadily towards a magical 150. The 10-year Japanese bond yields are also trading about 0.25. That's a line drawn by BOJ. But at the same time, today they did not spare time in announcing another emergency bond buying program. It's keeping the Japanese yields once again around 0.25. But as we reported earlier, hardly any trading is taking place. And this is completely two different worlds. Yields are rising everywhere. EM, BTM or DM, and Japanese yields are stagnant at 0.25. One shudders to think what happens if there is a breakout and if Japan stops to buy the yields. Surely they cannot continue this forever, particularly considering that inflation is on the rise even in Japan. We will have the CPI from Japan itself tomorrow, and maybe that's the one trigger that can hit the Japanese yields also higher. As far as the yuan is concerned, trading higher than where it was when the Chinese authorities warned about intervention just before they broke into the national holiday week last month. But again, there is no respite for Chinese yuan because of the continued problems the economy is facing. new restrictions on exports to China imposed by US authorities, as well as some murmurs of geopolitical tensions in the Asian region. So none of this is helping. So in this scenario, I think rupee moving lower was definitely on the cards, but definitely market was not expecting the kind of move that we saw. In the sense, the swiftness of the move was not expected. GBP and the euro again started to weaken after being unable to break through 1.14 and 0.9850 respectively. GBP was hit after the retail inflation for September came about 10%, compounding the challenges the government is facing after the mini budget fiasco. Adding to its moves was the political trouble with one of the cabinet ministers in the Truss government resigning, and Mr. William Bragg, a member of the Conservative Party, moving no confidence motion against the PM Truss, also joined by 100 MPs of the ruling party. So without a resolution of the same, markets in UK are likely to see fresh turmoil, which would spill over to other markets, definitely. Actually, the betting markets are showing odds of Liz Truss being pushed out of office, rising to 67%, as many punters are betting on her leaving before the end of the year. If she leaves the PM post, it would be a third PM to quit after UK leaving the European Union, with outlook on economy remaining relatively murky, ballooning borrowing costs, soaring consumer prices, and government in chaos. Investors are wondering, what magic wand can they wield to move towards stability, and surely it's going to be a long road. Normally we don't focus so much on the data and the happenings in the UK because that concerns us less. But this time, this is the time when any news, bad news anywhere in the world is actually impacting the rest of the world, and more particularly the rupee as well. Yields have been, on a set free now, and 10-year is touched 4.15 and still going strong. 30-year is at 4.14 and 2-year is touching at 4.556. To further avoid the meltdown in the bonds, we will not be surprised to see US Treasury undertake a special operation to absorb the selling in the bonds. Because already we are seeing a lot of selling by the foreign central banks who are trying to fund themselves with dollars. Now, more banks are forecasting a terminal rate above 5% for the Fed. One particular bank is actually forecasting near 6%, and that is very scary. Upgraded assessment of the economy in Fed's bid book added to the upward pressure on the yields. Although the housing starts in September saw a very big downward revision, and even the previous month's number was revised downwardly. Housing sector is one which is seeing steady decline in US, as evidenced by various data and 20-year high mortgage rates impacting. Stocks were lower after 2 days of rise. The rise was helped by corporate news, and now again the yields going higher, and the poor housing starts impacting the stocks yesterday. Let me end with some sort of relatively better news. The global supply chain issues have now reportedly eased to pre-pandemic levels, with commodities and used car prices helping the lead in the way down. Hopefully, this translates into a lower inflation rates in the coming months. The second is that Europe just avoided hitting a double-digit inflation. The year-on-year number came at 9.9 versus 9.1 last month, but market was expecting 10%. But 9.9 is still very high, and doesn't give comfort to the investors, as ECB is on par to hiking rates at the next several meetings. So all in all, volatility is not ending. So risk management rules supreme for our corporates, and hopefully, things settle down in not too distant future. Thank you.
I totally agree with you, JK. I mean, the volatility is something really interesting to watch how things are going around in financial markets. But I do hear a couple of things, and some on the scary side, some on the positive side, with the positive being the supply chain issues coming back at the pre-pandemic levels, folks. This can be some bit participating in the inflation coming down, along with the demand skill that all the central banks are trying. But all said and done, yes, it's not just UK, but a lot many nations across the globe which are struggling with murky politics, burgeoning debt, and high inflation. So a lot of magic wands are already there waving in the financial markets. It needs to be seen how and which wand magic does actually work around, and what we are going to see in the coming days. But on the dollar front, if we have to talk, yes, there was a lot of outflows, as JK mentioned yesterday. But at the same time, our own central bank, as was seen earlier, in the market intervening, was not really present yesterday. So basically, it cleared out, as JK mentioned. The RBI's actions are more or less to reduce the pace instead of maintaining certain levels. So that's that for today's update, folks. We shall come back again tomorrow with another round of updates in a extremely volatile and highly moving financial markets.